Hi everyone, it's Jack back with another video, and today I'm going to be talking about Zoom Video Stock, a company that did absolutely fantastic during the pandemic, was up towards $500 at one point. Its 52-week high this year is $251, and it is way off that, currently sitting around $80, down 56% year to date, obviously tremendously down from its all-time highs of 2021 and late 2020. It's trading at a PE around 24-25 right now, market cap down to just 24 billion. It's getting towards IPO prices actually when it IPO'd in 2019. It's an attractive business, although obviously not as attractive as it once was. I think it's actually starting to look like a value stock. It's clearly not the growth business it was. It's not going to be experiencing 100% plus growth rates anytime soon. But it released its earnings today, and I want to analyse them, tell you what I think, and then decide whether we think this is a buy, sell or a hold going forward. Like and subscribe if you're enjoying the videos going forward. Let's get into it. So a relatively high level summary up first. It's definitely a mixed quarter. On the revenue basis, $1.1 billion for the quarter, that's up 5% year over year, roughly in line with expectations, actually a slight beat. Of course, this is mainly because of large macroeconomic headwinds in Europe and the Middle East and Asia Pacific, specifically with the cost of living crisis in many countries, high inflation, and of course, the currency headwinds are absolutely terrific for many of these places due to the strong dollar. So while 5% revenue growth may seem like a lot, it's actually more like 7 or 9. So a decent result, but as you can quite clearly see, expectations have changed for this company. It's no longer really not even a hyper growth company. It's not even really a growth company at this stage. It's just kind of in the same realm as older world dividend aristocratic style companies with this sort of revenue growth. 75.4% growth profit, which is excellent, up 122 basis points year over year. What concerns me greatly is the expenses have increased dramatically. 17.8% R&D expense as a percentage of revenue. Sales and marketing expense 38.8%. That's up 1,000 basis points or just over. These are terrific increases, and also operating profit took a massive hit on a GAAP basis. 2,164 basis points down to just 6% operating profit. 34.6% on a non-GAAP basis, but this is even still a decrease of 457 basis points. So therefore, earnings per share took a big hit on a diluted basis, down 86% year over year. Even on a non-GAAP basis, it was still down minus 4%. As I mentioned, some currency and macroeconomic headwinds with the business blamed on poor results, as you can see here from the revenue split, minus 3% year over year growth in Asia Pacific and minus 9% in Europe, the Middle East and Africa. Now of course there are currency headwinds, of course, macroeconomic headwinds, but still America's where the currency headwinds are obviously playing no effect. They've recorded a decent result, up 11%, some big enterprise customer wins, and generally enterprise revenue was up 20%. So while the consumer business is lagging slightly, the enterprise is ticking along quite nicely. The revenue share by region continues to be extremely large for the Americas, by far the most important part of this business, at now 70%. So a good result here is really all we're looking for, although it is quite worrying that they've lost $80 million of quarterly revenue from Europe, Africa and the Middle East, but currency headwinds are a real thing though, and this is actually going to be more like probably 3 or 4% down. One thing that I really appreciate about this business, and I actually think is slightly underrated by investors, is its excellent balance sheet and strong cash flows. As it's moved from growth to value, it's a really good example of what should happen with free cash flow margin, and they have prioritised that. 24.7% on a non-GAAP basis, $273 million of free cash flow, operating cash flow of $295 million. They have maintained a strong balance sheet. They spent a little too much cash on repurchases for my liking above their cash flows, but they still have a really strong balance sheet. $5 billion or 5.2 nearly billion dollars of cash on the balance sheet. For a $23 billion company, that's quite a lot. You're looking at 20% plus of the entire market cap of the company is just cash on the balance sheet. With these operating cash flows, they can continue to increase this. I'm actually quite glad that the Five9 acquisition didn't go through, because that would have been really dilutive, or taking on a little bit of debt at something like $15 billion at the time. Obviously would have looked ridiculous considering how much the valuation of Five9 has decreased now. But of course, I think this business will definitely use this cash for mergers and acquisitions in the near future, most likely acquisitions, because I think it's definitely burning a hole in its pocket, and Zoom needs kind of, for the reputation of this stock, the optics, it needs to be increasing its growth rate going forward. A lot of companies have been falling short on the outlooks for the full year and the next quarter, and Zoom is no exception. Revenue of about 1.1 billion, that's roughly where it is today, so flat or down slightly. The range is very tight, so I'm expecting it to be roughly flat, 0% increase. For the full year, they're going to record around $4.4 billion of revenue. On a constant currency basis, they're expecting operating income for the full year for around 1.5 billion, which is decently strong in my opinion. The weighted average share count is going to increase slightly, but nothing to be too concerned about. Stock-based compensation definitely is a concern of mine for many growth companies or ex-growth companies like this, and they do need to bring the stock-based compensation down as time goes on. Even if they're buying back $1 billion of shares, the share count is still going up, which is a little concerning. Zoom is an interesting case of what needs to happen with all software-style businesses eventually. They need to transition from being valued on a price-to-sales basis, which at a point Zoom had absolutely astronomical, more than 50 times sales. Now it's valued on an earnings basis. Right now its price-to-earnings ratio on a trailing basis is around 24-25, on a forward basis around 22.5. These are historically incredibly cheap for Zoom. Of course, Zoom has often not recorded a lot of earnings. I think going forward, if this multiple is only going to decrease as it continues to produce decent earnings going forward. However, the market just doesn't seem to be appreciating this business. It's currently trading around 19 times free cash flow, which I would consider quite cheap. Under 20, I would consider to be reasonably valued. 19 times free cash flow is strong, and obviously very strong for Zoom's history. I think based off these metrics, this looks like reasonable valuation for this company. Again, the PE ratio is slightly above the S&P 500 averages on both a trailing and a forward basis. I don't believe this is an absolutely outstanding company by any means. I don't believe it really deserves to be trading at a great premium to the S&P 500, if any. It's growing revenue, 5 to 7% yearly, maybe 10 if it's lucky. It does have excellent gross margins, but it's spending a lot on stock-based compensation, and that's hurting the cash flows. I did a brief DCF calculation to try and add some more colour to this. I think they can grow free cash flow in line with revenue growth going forward. The revenue is, in the region of 5 to 10%, so I thought I'd go for 7, which is what they recorded on a constant currency basis this quarter, using the free cash flow value and a 9% discount rate. This gave a fair valuation of $64.72. That's compared to a present day stock price, which will be down tomorrow by the looks of it because the stock is down 5% after hours, of around $80. So that is not an enormous premium, but it is modestly overvalued. By no means would I not consider buying this stock if it was modestly overvalued, slightly above fair value. I just don't think this is the quality of business. How I would summarise this is I think Zoom is a decent business, but it's absolutely not a growth company anymore. And because the transition has happened so fast and basically it declined so quickly, the optics of this are just really bad, and the viewpoint of many investors is that Zoom is an ex-growth business with not a lot of prospects, has massive competition from Microsoft Teams, and that is really pretty much the only reason I'm not buying this stock. It's actually starting to look fairly valued. I just don't believe it can outcompete Microsoft Teams on a long-term basis because of its incredible integration with Office. I mean, if you're paying for Office, which pretty much most enterprises are going to be doing anyway, why would you not just use Teams? You have to be really against it, in my opinion, to stick with Zoom. So I can't really see this business doing that well going forward, but I'm clearly being proven wrong. That is a personal opinion. They're growing revenue at 5 to 10%. I think the best thing Zoom could do now is start repurchasing shares with its cash flow, focus on its cash flows, bring the sales and marketing expenses down, which is unnecessary, focus on the core business, bump up the R&D spend a bit, try and pump a bit of money into this business, and away from sales and marketing, and improve the product, try and differentiate itself from Microsoft Teams and make itself the verb. While it is already the verb, many businesses use Teams, and Zoom is by no means has any real moat, in my opinion, and it needs to develop that moat. I think what would go a long way to making this business a more attractive investment for a lot of people is paying a dividend, repurchasing shares, using that cash flow to improve its returns to shareholders. Of course, that means that I don't actually think they're going to do that. I think management is kind of obsessed with this idea that Zoom is going to get back to where it was, or to grow by acquisition, or to get back to high rates of revenue growth. As you can tell, their sales and marketing spend right now is enormous. So with that being said, I don't think this is a buy right now, in my opinion, and I will not be purchasing any shares of Zoom, although I'd like to be proven wrong in the future, of course. Let me know what you think in the comments down below. Let me know if you think this is a buy, sell, or a hold right now. Obviously, this is a very distressed business, so I'm interested to see what your thoughts are. Like and subscribe if you enjoyed the video. I'll see you again next time.